Well, inflation is actually quite different in different parts of the world. Here in our home market in the UK, which I think is the one that probably affects us most, inflation's been a bit stickier, particularly services inflation. The rhetoric from the Bank of England is that they would like to cut rates, but they will only do so at a sensible pace. I think as we sit here, as we come to the end of 2024, we would expect a small number of cuts, between 2 and 4 cuts in the base rate next year. That should have a good impact on bonds, but also things that we know to be cheap, like smaller companies, areas that we see real value in. Again, there are a disparity of valuations. The US market is expensive versus its own history and expensive on any PE or long-term PE ratios that one might look at. Other markets, which we actually really like, are things like India, which is also really expensive versus other global emerging markets, or again, indeed, its own history. But in both cases, we can actually make a good long-term case for why they are at those expensive valuations. Europe, Japan, average to slightly expensive maybe. Our home domestic market, the UK, we think is still cheap, particularly in mid and small sized companies where they are trading at much bigger discounts than they would on any long-term average. So UK is cheap, particularly UK smaller companies. Well, it's difficult not to be concerned about some of the things going on in the world. We've recently noticed that the President-elect Donald Trump is going to be the next president. What we don't know is what he's actually going to do. There's a lot of rhetoric in what he says he might do. So we know the easy thing for him to do is going to be to increase tariffs on trade, particularly on China, but also in Europe and the UK to a lesser extent. So that's sort of an economic thing. But what we don't know is what the impact that the new president's going to have, particularly on Russia, Ukraine, or the Middle East. So I think those are genuine concerns. What we also don't know is whichever way those foreign policies are enacted, what that will mean for markets. So I think a general air of caution and balance is appropriate for the year ahead. Some form of, risk off, like government bonds or bonds that may benefit in a flight to safety, as well as, some high quality equities. And it's always difficult to ignore the US, even though it is an expensive stock market, because it's the most important stock market and has been the best performing stock market over the last decade. Long-term investing is really difficult. We try to take a range of inputs from sort of macroeconomics and inflation, unemployment, and we also look at company valuations and market valuations. The one thing we know is that it's very difficult to switch all your money in and out of cash to equities. That's a high-risk strategy, and often people go to cash when equities have gone down. What I would say for the year ahead is I think it pays to have some balance and some diversification. I definitely think it's worth having some fixed income for the diversification that you get from equities. But when we look at equities, the US is the most powerful and biggest market. It would be difficult to ignore it, but I wouldn't be adding an incremental pound to the US today. I think with respect to the funds that we advise on, we're actually adding more into the UK and particularly into UK smaller markets and some specialist property REITs, which should benefit if we get a slight cut in interest rates in 2025.